The Consumer Price Index, the CPI, rose 0.4% in February, putting the annual inflation rate at 6%. Both rates were pretty much in line with expectations from stock traders. The CPI is a broad measure of the price of everyday goods like food, energy, and housing. So while energy costs went down in February, food and housing costs went up. Food was up 9.5% year over year. That is a lot. You're probably feeling that at the grocery store. Economists predict the Fed will raise its benchmark interest rate 1/4 percentage point next week. Now, to discuss the latest CPI data and other business headlines, we are joined now by Professor Emeritus of Economics at the University of Maryland, Peter Morici. Dr. Morici, thank you for joining us.
Nice to be with you.
I want to ask you about the CPI and just get your take. But year over year inflation at 6%, that is the lowest that it's been since September of 2021. And then core inflation, which is the inflation number without food and without shelter, is still up without energy, is still up 5.5%. But that is the lowest since December of 2021. So I know there's still inflation, but it does seem like things are going in the right direction, unless you disagree.
They are going in the right direction, but very slowly. If you look at the rate of decline of the last few months, it's very, very, very slow. But more importantly, we like to focus on the service sector right now because of all the pressure in the labor market. And if we look at core services, that is, if you take away housing, which is actually improving, and you take away energy, and you look at things like movie tickets, airline fares, doctor's visits, things of that nature, that inflation rate is rising, and that's where we get a very good measure of labor costs and labor pressures. And also, there's a lot of rigidity there. For example, when was the last time you saw a restaurant change its menu prices downward?
Never. I think I spent $11 on 2 coffees for my wife and I the other day, and that certainly isn't going down anytime soon.
Well, think about this. Near every workplace in every major city, there's a guy that sells scrambled eggs, bacon, sausage, and toast every morning. And he's raised his prices because the price of eggs has been going up. Well, for the last month, the price of eggs have been coming back down. Has that restaurant lowered the cost of the basic breakfast? Doubtful. I don't know. You could show me 3 examples of a price cut at a restaurant that sells bacon and eggs.
Well, let's do an exercise here. If you have lowered your prices and you're in the Chicago area, please email me directly. I will bring my family to your restaurant. I do want to talk to you, though, about the Federal Reserve and interest rates, because the Federal Open Markets Committee is going to meet on March 22nd. I think if I had asked you this question exactly a week ago, we would have been nailed on 50 basis points. They're going to raise this thing 0.5 percentage point. And then we have multiple banking failures and a lot of, fear. It's a culture of fear right now as to what's going to happen next. And so I wonder how much the banking failures will lead to a lesser interest rate hike, even given that inflation is headed in the right direction so far with increased interest rates. It's like you've got one that says raise the interest rate, and you've got one that says drop the interest rate. What do you think?
Well, just think about it. This is like baseball. It's a whole week away. We could play 6 more games. Think of how good we were feeling a week ago, and then we had the crisis at SVB, and over the weekend, everybody was in a frenzy and a panic. And then by Tuesday, everybody was feeling better because the Fed was going to guarantee the deposits. My feeling is if nothing else happens, boy, isn't that a big if in economics? We'll see a 1/4 point on next Wednesday. And that's really not quite enough of what I think we need, nor do I think what is possible to curb inflation. My feeling is this business with SVB was greatly exaggerated on Twitter and the social media and so forth. What happened there was a classic Bailey Savings and Loan. That bank catered to a very small group of people with a lot of money, and they all ran and put their money in the Bank of America, JP Morgan, and Citibank over the weekend. That doesn't sound to me like a banking crisis. It sounds to me like one small bank got in trouble.
Building and loan. That was It's a Wonderful Life reference for those of you that didn't catch it. There was an episode of The Daily yesterday, the New York Times podcast, that suggested that the federal government, the Federal Reserve as well, got bullied into bailing out some very wealthy people that had their money in Silicon Valley Bank. They were threatened that this would be a contagion that would continue, and they panicked and decided to do, within a couple of days, something that took pieces of legislation back in 2008. Thanks for watching. Go to newsnationnow.com to find NewsNation in your cable lineup. And don't forget to click the red subscribe button below to get more of NewsNation's fact-based, unbiased coverage.